The Hedgeless Horseman here. It's December the 8th, 2023. Just thought I would do a short video before the weekend. First of all, thanks to the sponsors. And yeah, let's dig into it. I'm gonna talk about some copium and yeah, I mean, it's just some common sense and maybe mention a few companies, talk a bit about selling as well. First of all, just gonna go over a few tweets. I think this is pretty spot on. You probably have noticed that the likes of, I was going to say Rob McEwen, Frank Gustra, I mean, they keep showing up lately in private placements here and there, especially Rob McEwen participating in quite a few private placements. And as always, that's how I should say. You will see the typical naysayers. I guess I should start off with that. I mean, most people have no idea really how to invest, especially in a cyclical sector, especially in a volatile sector. So we all have our biases, meaning that if I don't know that you should simply buy when it's cheap, like right now, for example, and you're anxious and you're barely hanging on, you're waiting for a lower low or something like that. I mean, market timing, literally market timing, and that's almost everyone who does that thing. When you see some billionaires, let's say, buy, and you're not buying because you don't feel good at all, you have, you feel negative, you see the negative sentiment, you look in your portfolio and it's like, I'm down 50%, whatever. Anyway, so your conclusion, based mostly on emotional reasons, I mean, because it's almost impossible to spot a above average quality junior right now that is not cheap. That's my opinion. So when you see some billionaire, for example, buy into some of these juniors, and you're not buying in because you're scared, you're afraid, you'll typically see, in the case of Rob McEwen, for example, that McEwen Mining hasn't done too well. And I know someone mentioned, this was maybe a few months ago or weeks ago, I think it was when Rob McEwen took a stake in some junior, and someone immediately just said, well, just look at McEwen Mining. I mean, obviously what he's referring to is McEwen Mining hasn't done very well over the last few years. And basically he's trying to cast shade on, Rob McEwen is buying this junior, but that doesn't mean anything. Just look at McEwen Mining. I mean, that's the kind of stuff you see from, I was going to say haters or people who want to spread, what's the term? FUD, whatever that means. That basically they're trying to invalidate a billionaire's decision to buy because he has lost money on something. If you reverse engineer that, it means that, okay, you should only take a page or take a cue from even billionaires if they never had a not successful venture or investment or whatever. I mean, nobody does. Even Warren Buffett says, he's done a lot of mistakes throughout his life. So, I mean, it's just a ridiculous point to make. And someone mentioned with, what was it, Red Lake, what's that, Gold Corp. he made a lot of money there, and he was just lucky and all that. I mean, there's always excuses, and you see this with people casting shit on, let's say, funds or other people just on Twitter or whatever. As soon as someone has an investment or more, which is quite typical in this sector, that has not done well, or at least in the recent past. I mean, people throw that like, hey, don't listen to this guy, whatever. I mean, Jesus, it's just a ridiculous notion that, especially in a sector like this, high risk, high reward, and the higher risk and higher reward you go, meaning that if you're into early stage juniors, where it's like, if one is successful, it might go up 10 to 20 times. Obviously, you cannot expect to be right or look right, that much of the time. I mean, you can't be expected to have that good of a hit rate, because if you have a 50% hit rate with early stage, very high risk, high reward cases that can throw off 10 to 20 times the money or more. I mean, there's cases where something goes up 50 or 100 times. If you would have a 50% hit rate, you would be disgustingly rich. If you could keep that up, you would, it would just be insane. Whereas in reality, you might need to be right on 1 in 10 and stuff like that. But there's always going to be people who don't understand it. And when I see that kind of stuff, I know they have no idea how this sector works. I mean, they probably don't have any good investment returns. But still, I mean, my point is that everybody wants reality to fit with what they're seeing. Obviously, I mean, I'm like that as well. But to me, it's like, I don't know much about Rob McEwen or Frank Gustra or, some other billionaires, except that, okay, they're rich, they're probably smart, they've been around for quite some time, and I think they know more about mining and valuations and stuff like that than me. So when I see them getting aggressive, I mean, I take that out. And the same goes for Rick Rule. I mean, these guys have been, have 20, 30 years in this space. And they're rich. So, I mean, why listen to people who claim to know what they're doing? Let's say just follow the people who are actually rich. I mean, they are the only ones that kind of prove that they know what they're doing. So anyway, that was a bit off topic, but it's like you see ridiculous stuff all the time. Like, that billionaire, don't pay any heed to what he's doing because he had a bad investment in this or that. Like, yeah, but he's still a billionaire, so obviously, he must have some successes. But the point is, I'm going off topic as usual. We're seeing billionaires increasingly participate in the private placement of junior, I would say gold miners primarily. We see majors, we see mid-tiers. I mean, I've seen, quite a few juniors announce, strategic investments or, someone is adding. I mean, if I'm not mistaken, BHP added in Brixton, for example. Again, that's like $100 billion company. So it's like, I would take a cue from that, and especially given the valuations we're seeing out there. I mean, some of these juniors, they're not pricing in anywhere close to having something that a mid-tier or a major would be interested in. And the billionaires who invest in these juniors, they're not looking for 50 or 100% returns. They can't sell, they can't flip. They're looking for the, potentially 10x returns. But that's going to take time. But you see this happening. Majors, mid-tiers, and billionaires, they are buying. And of course, the thing is that it's the retail sector, it's retail people, it's your neighbor that is driving the everyday trading in these juniors. I mean, you see private placements done with strategic investors like majors like Glencore, and they're forking up 55% premiums to what the price is trading at. what the retail investor is saying. Hey, I think this is a fair value for company X. I mean, if Glencore and those entities, if there was enough liquidity that they could actually go in the open market, we wouldn't see prices like this. But you only see their, estimation of value. I mean, obviously, if you buy at a market price, people could say, well, it's fairly valued. Yeah, in one sense, I guess that's correct. But still, I mean, or let's say you see the Lundins get in at market price, do a private placement. I mean, the Lundins don't make too many investments, and they can't get out. So I mean, even if they are getting in at what the same price that the retail market has set the price at in the open market, intrinsically it means that they think it's way undervalued. Because if they believe that the market is always right and whatever, I mean, they would be investing in 200 juniors. Again, if you believe the assumption that the market is always right, because every price would be fair in that case. But you don't see that kind of stuff. So like today, I mean, I haven't checked metals much at all lately. I mean, I don't think I've been, looking at the market at any market open either. I mean, I really don't care that much. This is such a layup. We have been for easily a year, maybe up to 2 years, deep value. In deep value opportunity, basically. It's just crazy. I don't care if gold is up 1% or down 1%. What does that matter? Some of these juniors should already be up 100, 200%. Because they should be pricing in the future and everything like that. It's just absolutely crazy. It doesn't mean a thing, but you still see this stuff. It's like, I've been quite active today, actually. I don't know what prompted it, really, but like I wrote here, meanwhile, retail will give away their ownership for minus 10% less, 10% less than yesterday in non-producing juniors because gold is down 1%. I mean, think about it. It's absolutely ridiculous. Do you think the majors or the billionaires, like they buy in a private placement? And let's say, a non-producing asset, exploration asset might be a mine in 5 to 10 years, and that's when, the price of gold will actually matter. Do you think they give a shit if gold is down 1% on December 8th, 2023? Would they demand a 10% lower price? That 10% of the assets, and all the, what's it called? Human capital and all that went down 10%. 1/10 of the entire value of a corporation went down 10% because gold futures are down 1% on December 8th? Of course not. I mean, it's absolutely ridiculous how dumb this sector is. We have some of probably the worst investor. Well, that goes with a volatile sector. Just look at crypto. I mean, Jesus Christ. It's like 10,000 cryptos and people actually bought that stuff. No, it's just absolutely crazy. It's like, I know it's going to sound very arrogant and all that. I have no idea how you're expected to lose over the long term, like at least 4 or 5 years plus in this sector. To lose money on paper in a year, I mean, that's nothing. We've had a bear market for 3 years. It's like Seven Oaks here. True, but things are becoming concerning when multi-year positions are down 40 to 70%, even after dozens of buy lows. When I'm running out of cash, average down and continuous delays are forcing precious metal companies to more dilution. I mean, sure, but like, again, just look at where we are. It's nothing to... I mean, it's gonna sound weird, but it doesn't take a genius to figure out that, yeah, we're probably gonna be down since 2020, which is almost exactly 3 years, because that's how long we've had this sector in a bear trend. And obviously, or typically, the longer you've been in it from in this period of time, the more down you're. I mean, if you get in here, I'm obviously using Bear Creek as a proxy here, as per usual. If you've been in it from here to here, that's 3 years of a bear trend. It's the same with any bull move, for example. I mean, if you're in a bull for its entirety, the longer you're in a bull, the more you make. If you're in a strong bull but only stay for a month, you're not going to be up that much. I mean, it's nothing unusual with that. I mean, that's what I think people really have to work on. It's like short term, and in this case, I would actually say short term as 3 years. Because if you look at this, I mean, here we had a bear market for like 4 or 5 years. That was just one side of the coin. Then we had the strongest quarterly rally in juniors ever. We're still, if you entered around here, you still only seen one side of the coin, and you can't claim that that's your, I mean, expected long-term results. If you're down 50% in a market like this, I mean, that's nothing. You're probably outperforming most people, especially most juniors. If you're just down 50%, I would guess the median juniors probably down like 75-80%, something like that. And I mean, if this market is so smart and the market is always right, how on earth can you explain these moves? The market is always right, but it was only wrong that there would be a minus 95% move later. That doesn't make any sense. And then a 2,000% move higher. Then a 95% move down. Then a 655% move up. And then a minus 76%. The broader market averages 8 to 9% per year over the very long term. These moves here, mispricings of the juniors, it's like orders of magnitude what you would be expecting. It's like a black swan event every whatever, at least every like 8 years. This market is absolutely ridiculous. I mean, it's a silly market. How on earth can you take this seriously? How can you look at the prices today and it's like, yeah, actually I think the market is right. They are cheap, but there's a very good reason why they're cheap. I mean, that's what people said at every major low. Until they went up a truck ton. Or at every high. And of course, should be, I mean, the market is always right. I mean, if the prices are up here, I mean, that's because it's an efficient market. So I might as well buy here. And then it's just minus 95% wrong, not a few years after. No, it's absolute bullshit. I don't trust anything that the market is selling. It's obviously retarded. Why on earth would you give any credence to Mr. Market in this sector? I mean, don't get me wrong. It's not like everything is just batshit wrong or crazy or whatever. I mean, and you can explain a lot of the moves from short-term movements, like when Headwater went down. Yeah, it was the latest news release. It was a mixed news release, but relative to the market cap and enterprise value, in my opinion, it certainly wasn't warranted a sell-off. That okay, the value of the company is actually less than where it closed at the day before, and it should go down 20% and have a market cap of like 14 million Canadian. That is bullshit. So I mean, yeah, from a relative perspective, or everything is relative. In this space right now, if there's a mixed news release, if it's a slightly net positive news release, or even obviously positive news release, it might still not go up, even though it might already be so cheap that it should already be 100% higher. And the value just went up, let's say 50%, and it should actually go up 150%. Doesn't matter. So how much can you, how much respect can you give Mr. Market? I mean, it's obviously brain dead. Because it doesn't matter how cheap something is. If there's a net negative news release, it doesn't matter if the intrinsic value of a company's asset was like 300 million. No, let's say 400 million. It's selling at 25 million. If there's a net negative news release, and let's say intrinsic value went from 400 million to 350 million, and it was trading at 25 million. Obviously, it's grossly undervalued, but that's going to sell off because everything is relative. And now people, I mean, almost all the time in the short term, people are voting with their emotions. They react. They don't think about value. This sector wouldn't be this cheap if people actually did their buying and selling right now based on value. And the same goes for the highs and every low. It just goes right out the window. This is why this market is a joke. I mean, how are you expected to, in this case, for example, how am I expected to overpay for something right now? I can buy stuff sometimes for like 40% less than a major just, paid 2 months ago, whatever. You can buy the best teams in the business for peanuts. Proven projects with sunk costs, probably much more than the market caps themselves, for less than less than the sunk costs. They are juniors. They're trading like every metal is abundant and will never go higher and will probably go lower, and we won't have a mining sector. If you don't think that's a ridiculous consensus by Mr. Market, I don't know what to say. This is absolute bullshit. It's been bullshit since here. And of course, the thing is, volatility is a double-edged sword. Case in point, I have strained my back actually, so I'm hurting a bit. Okay. Take this thought example. We have two people. One will start monthly buys after 95% of people are convinced it is a bear market. Take whatever sector. The other person will start monthly buys after 95% of people are convinced it is a bull market. And then that's when they start buying, and they buy, some fixed amount every month. And they buy up until the point where we have these sell conditions. Both must start selling 10% each month. I mean, you could pick whatever. After their buy conditions flip to the opposite. So the first person here, he starts buying when 95% of people are convinced the sector that he's about to buy in is in a bear market. Meaning it's absolutely obvious it's a shitty, crappy market. Has been. Obviously, that's the thing. It has been. Up until that point at least. And he will start selling when everyone is convinced that it's a good market. I mean, when you think about it, this is literally how most people act. I would say less than 5% actually make any money. I mean, they say 1 in 20 beat an index. In this volatile sector that is the junior sector, I would be surprised if... I actually don't know. I mean, I think it's less than 5%. The thing with volatile markets is that there's no others. Well, the more volatile it is, if you know what you're doing, you cannot beat the returns you can get in a volatile sector. You will not see the S&P 500 pull 2,000% in 2-3 years. And you won't see it go down 95%. most people dream about this kind of movement, obviously, just a steady climb higher. That's what they would like. But if you actually use volatility, you can obviously make a lot more from that. I mean, if you just, let's say this graph, for example, if you just had an average here and sold up there, whatever, that's 150%. And this is, let's say, 100%. I mean, these are not long time frames even. So if you just had if you had like 2 trades like that within let's say 10, 12 years, first 150%, so you're up to 250 if you started with 100, and then double again, so that's 500, so that's 400%. That's not a bad return. I mean, the average market average is 8 to 9. Then slap on that you do some good due diligence, that you actually buy increasingly when it goes cheaper, etc., etc. You can juice these numbers up a lot. And like I've stated before in other video, it's like, and this is, I think, really drives it home. It's obviously not the bear markets themselves that is the problem. It's not like you can never invest if it's a bear market, or if you ever invest in a bear market, I mean, you're doomed for failure. It's obviously what we do in bear markets. I mean, Berkshire Hathaway, or take any other long only fund or whatever. It's not like they never experience a bear market. I mean, if you listen to Peter Lynch and Warren Buffett and Charlie Munger and all that, I mean, they're talking about, hey, they like bear markets because they can buy cheap shares and get higher future returns. But if you listen to most people, it's kind of obvious that what people want is like buy low, because everybody talks about buying low, selling high, etc., etc. That at face value, that's what they want. To buy low, have very high long-term returns. I mean, that's why they're stock picking. By definition, that's a kind of arrogant thing. You're saying that, hey, I think I can pick better than an index fund or whatever. So you're looking to buy low, because that's what you hear and that's what you tell yourself and everyone else. And very high long-term returns, that's where you're stock picking. You think you can do better than the market or an index. And you should never be investing in a bear market. I mean, the problem with that is it is in the bear market that you are able to buy low and get the high future returns. But I don't know if you notice, everybody is complaining that we're in a bear market. The same people that want high long-term returns are complaining about them being able to buy companies' shares this cheap because we are deep in a bear market. Obviously, that doesn't add up. If you want high future returns, you need to buy low. If you talk about buying low, you need a bear market. But they want everything without the bear market. It's just absolutely crazy. Obviously, up here, no bear market in sight, no bargains in sight, very low future returns. I mean, it is just crazy. It's like, I think people think investing is a lot harder than it actually is. I don't know how to explain it. For the life of me, I cannot understand. Once you get this, a cyclical sector will forever be cyclical. And how actually that investing is not about what has happened, it's about what's gonna happen from here, or could happen. Or I mean, in a high risk, high reward scenario, it's the risk reward. Anything can go down in price. I've never owned a single stock I don't think can go down more. But it's the asymmetrical nature of it all. Up here, could all juniors go up more? Sure. Maybe it required gold going to, I don't know, 3,000 and they double or whatever. Down here, just as long as the mining sector didn't get completely wiped out and civilization ended, we would gonna have, there's upside ahead someday. That's highly skewed risk reward. It's like some juniors now. I mean, it doesn't matter how cheap something is. There's always going to be someone who say, I mean, somebody commented on a tweet today. I just posted a short and he said, it could go to zero. I mean, it doesn't get more useless than that. Of course and I just responded with it can go to $100 per share. I was obviously being cheeky about it. But that's just stating the obvious. It's like, that's not useful information. Because you can use that as an excuse to sell low anytime you want. So it's like, if you can't buy a stock until you know it can't go lower, you'll never buy a stock in your life. Well, back to this. Okay, so how would this play out in practice? I mean, it's at face value. I bet if people didn't think about it, the deeper meaning of this, I think actually people believe that this person would make more money. Because it's like, yeah, okay, this guy starts buying when it's obviously a bull market. Again, the problem is when it's obvious it's a bull market, it means the past trend, what has happened, has been a higher market. I mean, we have been in an uptrend for so long that people can see it has been a bull market. But when you think about how would this play out in reality, I mean, and this is how most people think. That you shouldn't be investing in a bear market. You should invest when you know it's a bull market, and you should get out when you know it's a bear market. How would this play out in reality? Okay, one person starts buying when everybody knows it's a bear market. I mean, maybe 95% of people were sure it's a bear market here already. And obviously, it went lower than that. It went, again, using this as a proxy, 70% lower. But let's say, okay, how would this play out? So he triggers the buy condition here. 95% of people, you ask, think the junior sector is now in a bear market. I mean, who knows? I mean, where would people come to that conclusion? I don't know. I mean, it's still a higher high than here. The level it has not broken this level. But let's give it a wide berth. Huge downside potential still. I mean, which we now know in hindsight. But let's say he starts buying here and he follows the protocol. So he buys more every month. And down here, I mean, I would say 100% of people are convinced it's a bear market. But the sell conditions is not in yet. It just in reality, you should buy even more, obviously. But let's say he just sticks to the plan. As long as the sell condition, which is 95% are convinced it's a bull market, until that is in effect, he keeps buying every month. So he starts buying here. Buys. Maybe he has an average down here, whatever. And he just keeps buying because the sell conditions of 95% of people being convinced that it's a bull market is not in effect here yet. I mean, this is probably people are going to say, well, this is a dead cat bounce or whatever. So obviously 95% won't be convinced it's a bull. But he just keeps buying. But up here, let's say, well, maybe actually here or here, or what, I don't know. I mean, up here probably 100% would see this as a bull market. And again, the thing is that, yes, it's been a bull market. That doesn't mean it's going to be a bull market. But here everyone is convinced this is a bull market we're in. But the more people are convinced it's a bull market, the closer we are to the end of it, obviously. When 100% of people are convinced it's a bull market, it means that every single person has bought in because every single person is convinced this is going to go higher. So then the question is, who is left to buy even more shares higher? Everybody's in. There's nobody that can buy more stocks because everybody has already bought. Then some of the bulls maybe needs to take profits or needs to sell something to buy a house, so he starts selling. And again, everyone is all in. Okay, nobody left to buy. Still nobody left to buy. Then somebody, maybe another person, he has a kid, he needs some money for whatever, or he has he's gonna start a new job and needs new suits or whatever. There's nobody left to buy because everybody's already all in, and then there's just a net drain ahead. And sooner or later, obviously, we have some trend forming, and most people are trend followers, so they're not going to get bullish because it's gone down, and it's just going to keep on selling until the unluckiest person, I'm not going to say unluckiest, the dumbest person in the world sells the absolute low. And then they have no shares left to sell. When they run out of shares to sell, or there's no more net drain or something like that. Because the problem with this sector, which the comment pointed out, is yes, there's dilution. That's the thing. There's typically a net drain all the time in this sector, which is a problem because it's gonna, be kind of a wet blanket. But let's go back to the point here. So if you understand what I'm trying to say here, is if you just started buying when everybody was convinced it's a bear market, you bought, and your sell condition is when everybody agrees, almost everybody agrees that it's a good market. And I don't know where that would be. Maybe, I mean, literally, if we were here, I mean, wouldn't you be scared that this would be a lower high and we would just go down like this was? How did anyone know that this wasn't this? I mean, obviously here we have a different trend before that, or this, for example. Okay, it went up to around the same level, but here it actually went down, and now we're down here. In this time around, it actually went higher. Who knows? Nobody can know this. That's the thing. We're not after market timing. We're after skewing the odds. But up here, I bet 95%. And if we would have, let's say the buy condition or the sell condition, 95% bullish, wasn't in place here, you would just keep on buying until we reach that, for example. But okay, the person who's only allowed to start buying in a bear market, he starts, let's say, starts buying here, buys all the way up until here, where 95% of people are convinced this is actually a new bull market. I don't think there's no way that people just 95% will not be convinced it's a bull market here. I don't think so, at least. But up here, sure. And then the sell condition is in place. When everybody agrees that there's blue skies, well, what people actually mean in practice is that, again, the times have been good. It's not that they're gonna be good. When is the entire bull still ahead? When everybody is convinced that we're in one of the worst bear markets ever. There's no way you're gonna catch close to the full bull move if you wait until you know it's a bull to buy. And let's flip it around. Okay, the other person who only invests when everybody agrees it's a bull market, and he sells when almost everybody agrees it's a bear market. How would that play out in practice? He would start buying here probably. Buy every month. Okay, buy. Okay, let's say the lower this goes, more and more people are convinced it might not actually be a bull market, that it won't go just like that and even higher. But people don't know that, obviously. I think the consensus will be obvious maybe, I don't know, I mean, when does 95% agree this is actually not just a higher low and it's gonna go up? I don't know. I mean, down here, let's say it starts maybe down here when it's like this is becoming the real depression levels. So we bought here when the recent past and the even medium term past was great, and almost everybody agrees, yes, we are in. Up to this point, we have been in a bull market. Again, focus on have been. It has been a bull. So then you're comfortable buying. And you sell here. Start selling here. Because now everyone agrees that this is a bear market. aka it has been a bear market. So he starts selling out until this bear runs out of steam again and goes up. I mean, that's what people do. Obviously, I mean, you can have this exact same chart here. Take two arbitrary buy and sell conditions. They're the total opposite of each other. I would argue that their returns would be completely different. The one who only buys in an obvious bull, he's gonna be. I mean, he's gonna be absolutely killed over the long term. The more cycles you give that guy, the more he will lose. Maybe he lost 70% here, then he'll lose 70% over this one, and 70. I mean, he's gonna grind himself to oblivion. Whereas the person who only starts buying when everybody agrees it's a shitty market, it's a bear market, keeps buying until everybody agrees that it's a bull market all of a sudden. Again, contrary to how people act on Twitter. They complain about bear markets. They hate bear markets. My God, bear markets, bear markets. Oh, crap. I should be in a sector that's a bull market. And that's what they're going to do. Obviously. I mean, that's what most people do. They sell here and find another sector that is up here already. And then they do the same thing. It's just, same behavior. It's just different sectors. Because they believe, I don't know who gets them to believe this, but that you're supposed to only be invested in bull markets. That's the most ridiculous thing I've ever heard. How on earth do you know if it's a bull market, except for hindsight? Up here, we know it's been a bull market, but if this is the top, I mean, what does that help you? Yeah, up here you say, I should have bought here. So why do you buy? Well, I should have bought here, so now I'm buying here. I mean, that doesn't make any sense. The more people are convinced it's a bear market, I think it's just a great signal. Again, maybe 95% believe it's a bear market here, or 98. Down here it's 100%. Except for probably I remember Ross Beatty, I watched a presentation, he said he was buying, he was bullish. Of course, I mean, he's a billionaire. He bought low. And now we're seeing billionaires again, more and more so, I would say, buy. We see majors, we see mid-tiers, they're getting into private placements. And the funny thing is we see, some of these minerals getting put on the critical minerals list. Look at the juniors, how they're trading. It's not... If you look at the valuation, you wouldn't believe they have something even remotely close to critical minerals. They are trading like they have something, more in line with abundant minerals. Copper juniors are in the trash. Most of them, at least. Nickel juniors, gold juniors, silver juniors, everything. I mean, my point is, everyone overestimates or underestimates how absolutely dumb the markets are. And especially this sector or a volatile sector. I mean, it could be, I think, biotech or whatever, but it's like volatile, high risk, high reward sectors. I mean, they are some of the most, it's absolutely ridiculous. But key point, and I hope you will agree with me on this, And I think that's when you have that understanding, I think it's a very good sign that can we agree that it's obviously not the bear markets themselves that by definition are negative. It's what 95% of people do in a bear market and a bull market that gets them in trouble, right? Because you could have two people buying in here. Now the bear market has happened. Both look at their accounts. Both are down 70%. So from this time to this time, there is no difference in their portfolios. They both look, and I mean look, equally dumb. One person sells. He makes the paper loss permanent loss. He walks away. The other person adds 50% or whatever. And his average, his GAV or whatever you call it, goes up here. So he's still down, but down less because he actually added down here. Then this happens. He makes money. This guy, let's say he walked away from markets. He doesn't believe he should be in stocks. He probably shouldn't be in stocks. Both had exact same start. Both took the full brunt of the bear. One person left with a 70% loss. The other person averaged down. And when it gets back to where he bought in the first place, he's actually up 100% over 2 years. Which is a good result. So can we agree in that case that it's not this move here that's the problem? If you want very high future returns, you need a deep bear. If you bought here, you got 127%. The deeper and longer the bear went, dry powder just skyrockets in future returns. So understand that. When people say bear markets are crap or shit or why should I be buying in a bear market, I don't think the bottom is in, whatever. They have no idea, in my opinion, what they're talking about. And you can go and listen to all the billionaire longs, let's say. And Google what they say about bear markets or cheap prices or whatever. So I hope we agree that it's by definition, it's the same with a bull market. I mean, what was I gonna say? I mean, yeah, okay, it's a bull market, but should you be buying up here? This is when you get in, versus this person who bought way before it was even considered a bull market. No, I think, obviously, in my opinion, you should buy when everybody's convinced it's a bear market. You should buy more the more people get convinced we're still in a bear market, a worse bear market. And you should sell when everybody's convinced it's a bull market. I look at my, positions or the hodl portfolios. I mean, they're up over the last 3 years. So, they've done quite well. It would feel worse if they were down 50%, obviously. But it's like, just look at some of these juniors that might have been around for more than just the last 3 years. Look at what happens to this sector when the bull comes. If you just stay for the red periods, probably not going to make any money. I can afford to buy. It's this kind of same thing. If you bought in here, yeah, okay, that feels obviously worse than buying down here. But I was gonna say, it's like I can afford to buy high because I buy even more low and add some stock picking and all that. Well, I mean, the only thing I do is stock picking. So that's also one thing. It's like, don't. I mean, the more work you actually put in, the more you deserve to make over the long term. But who knows? I mean, from this period here, the worst junior investor might have better results than the best junior investor, kinda. A month, a year. I mean, it doesn't mean that much. If you're down 50%, and we fast forward like 2 years, and most of the juniors are up here at least. If you're still down, going from here to there, yeah, then you probably are very bad at stock picking or have been extremely unlucky. But probably, I mean, risk management and all that. But I think this is a very good thought experiment. Because this is how people act. And then they sell when 95% of people are convinced it's the bear market. But in practice, that is absolutely going to wreck their portfolios. And the longer time you give them, the worse it's going to get. Whereas if the one who started investing when everybody agreed we are in a bear market, and it's, can certainly go lower because the trend is so strong, regardless if they're sitting at a 50% paper loss on their first purchase or 70, if they keep averaging down and they pick companies that at least, most of them will still be around, they're going to make money every leg because they're going to get out when everybody's, they're going to go from here to here in every cycle. Buy here, let's say get out there. So the longer you give them, they are going to be compounding positive results. Whereas the flip side is that you buy here and sell when everybody agrees it's a bear, which is down here. So they're going to take heavy losses, buy here, get out there, buy here, get out, let's say here, every time. So the longer you give them, the worse the returns are going to be. If you have a good strategy, and being a contrarian, I mean, I don't like that word. What is contrarian about buying cheap? I mean, it's just common sense and you act on it, but still, let's call it contrarian. No, I don't actually like that. No, if you just buy cheap and sell when it's not very cheap, or just buy when everybody agrees it's shitty market and nobody should be in it, and sell when everybody loves the sector. I mean, the longer time you get in the market, the more full cycles, I mean both down and up, not just down, you will have seen. You would have made money probably in every single one. And that's going to make you compound, obviously. I mean, if you made 100% here, so you double it, then you double that, then you're up 300%. So I mean, it goes exponential. That's compounding. Whereas again, if you buy when the coast is clear, everybody agrees we're in a good market, you're going to, let's say, lose 70% on average every single time. So you're going to have $3,000 left from 10,000 and then whatever, 70% of 3,000 and on until you're close to zero. That's why it's like a good strategy is always something that can be repeated. That's why I don't put too much faith on like single picks or something like that. And that's why I keep on harping on about, I mean, yeah, I could obviously talk much more about picks and stocks, give out fishes, which I think are, good fishes. But for your own sake, I mean, you should learn how to fish yourselves. I made money on absolute crap going from here to up here. I wasn't a good stock picker. I just knew how to buy cheap, which I'm doing this today, and I did it here and I did it here. Well, here I didn't have time to react, but I think I reshuffled a bit because I remember my portfolio went up a lot, 400-500%. Um, so yeah, I mean, I think that's better help, or I mean, to get the basics correct, because I mean, I don't know how many videos I've done now, and I get increasingly irritated by people who whine about this sector. When personally, for the life of me, I'm getting more and more convinced, like convinced. I don't know how you are expected to lose in this sector over the long term. Losing over this period of time, no genius needed. Most people will lose a lot of money. That's not the point. It's over the long term. If you just keep buying cheap, selling when it gets expensive, buying cheap, selling when it gets expensive, buying cheap. I mean, how on earth are you expected to lose? It's the most predictable sector there is. Like Pierre Lassonde said, it's the easiest sector in the world. It always crashes, always rallies, always crashes, always rallies, always crashes, always rallies, always crashes. You got to be pretty dumb to think that this time around the sector is never going to rally again. And we know what happens when it rallies. I mean, it's several 100%, up to 1,000%. So if you're down minus 50%, I mean, who the fuck cares? It's like, stop bitching about minus 50%. I got minus 54% in 4 months. Those were my first 4 months in this sector. Minus 54%. That's worse than being minus 54% if you've been in this bear market here for 3 years. I mean, imagine if you were down minus 54% every 4 months. I bought more. And thank God I did, because when this turned around, my portfolio went up 600% or something, 500-600% from this point to here. And all of a sudden, from this period to there, my portfolio's up like 250%. And then I started to learn about mining and did some stock picking and all that. Anyway, I mean, okay, this is kind of off topic, I was gonna say. I was like, you see shorts like this all over the place. This is Reina Silver. I own warrants in Reina Silver. I don't think I own any shares right now. I mean, it's not a high conviction pick for me. It's silver. They might make a discovery, who knows? But it's like, you see these bear trends. And you see these all over the place, I would say. Then the question is, if these companies are, I mean, let's say you find 20 juniors with shorts like this. If they will not go bankrupt or dilute themselves to absolute oblivion, they're going to break someday. When the inevitable upturn happens, all of those that are still around and haven't, again, not gone bankrupt or diluted, down 70% away, they're going to break all these trend lines. And these are pretty hefty, I mean, long resistance lines. And there's a ton of these juniors. You saw the same in 2015-16. They absolutely sucked until the market turned. All of a sudden you're in a bull. And just to point out, and I talked about this before, you can have, if you wait until, let's say you think it's really cheap already, but you wait until the breakout. I mean, in some of these, and this is not a bad example because I don't think Bear Creek Mining has great fundamentals, but let's say you have let's say this is actually a good misunderstood company. You have a trend line like that, let's say. I mean, I'm just trying to prove a point here. And you wait until, it breaks higher. Let's say it breaks higher there. And we go up to the same, so you get 800% returns, which would be absolutely superb. I mean, they have been diluting, so let's put it down here instead. Keep this trend line intact. 451%. Sure, I mean, that's nice and you get a trade. But if you have high conviction, this company is cheap, you think there's a good likelihood that it's going to break out of this. You're not waiting for the breakout to be, a technical trader, and you pile in down here. I mean, that's like more than double the returns. So you need 50% less hit rate in that case. So I mean, if you find something high conviction pick, preferably low risk actually nowadays, where you know it's like they have something significant. If you can pick 10 of those and have, I don't know, more than in early stage exploration juniors, and if they go lower, you just add, because it's you quote know that it's a matter of when, not if, they're gonna go higher and break whatever, let's say, traders resistance zones or something like that. I mean, you think there's like a 70-80% chance that they're gonna go up. They're gonna be at least around when the turn happens, and you think they're already very undervalued, so you're expecting like 300%, and you think there's upside for it to go up 1,000%. Why would you wait buying that and waiting until they gotten more expensive and break some arbitrary trend line? That, to me, that makes no sense. Yeah, I talked about this before. So one thing I've been actually adding recently is like nickel juniors. Here you have the nickel, and again, I'm not a good TA trader or anything like that, but it's like I like to look like my strategy back here, 2015-16, when I didn't know much about juniors or mining. I remember I just did a spreadsheet and looked where some of these companies like Great Bear, I remember Endeavor, First Majestic, I looked at how much they were down from the peak, just in share price. Didn't account for dilution or anything like that. And I typically bought the ones that were down like 97% and stuff like that. Those are also the ones that went up several 100% later. So imagine how simple that was. I just bought the beta plays that were down the most until they stopped going down. And I mean, not every single thing is down like 95% right now, but it's like, but there's a reason for that. Back here, every producer was losing money. So if some of these producers are down 70% and they're still making money, I'm not going to say not even close to losing money, but it's like gold is at $2,000. Here it was at like 11,050 or something. So you shouldn't expect them to be down 97% when the sector is making money overall. Anyway, so that's how easy I did. That was my simple strategy. I bought the ones that were down the most. Simple as that. So I mean, my point is that when I look at nickels, like I don't know too much about macro and stuff like that, since I'm a micro investor. I don't just buy companies in a sector because I'm bullish necessarily on the the metal itself or whatever. Nowadays I'm only stock picking really. I mean, I hope to buy companies that could do well if gold went nowhere for like 10 years. But still, I cannot ignore the fact that it's nickel price went down like 67%. Here it went down like 54%, and then before it went, I don't know, up 50%. I mean, that is a pretty good rally. Here, from this top to the bear market low, minus 65%. I mean, we're kinda, if you count this blow off top, we're already down as much as the last leg, which ended a bear market and was the start of a 2016 6-year bull market. But if you count from the top, I guess it's like 74, and in that case, if we would have the similar, that would be down here. And in that case, just from an analog perspective, obviously that could be more downside. 64. That maybe it's like we're here and it could be, but still, I mean the point remains. I mean the more sure we are, the worse the sector gets, the more you should be buying. So I'm getting increasingly bullish on these the worse it gets, because I see nobody bullish on nickel. Everybody's talking about Indonesia's supply. I posted something, about nickel, and people commented on that. That's like, well, nickel is gonna be dead for years or whatever. Okay, take that at face value. Is there a chance that might actually happen? Sure, but I mean, the Indonesian, they are not even low-cost operations, and they're very dirty. So there's a bunch of other stuff, geopolitical stuff, and cost that comes into play. Because I mean, they're not going to be mining forever if they're losing money on it. They're going to shut down stuff. And in that case, price would obviously rebound. But my point is, we know what the consensus is. We can see the price of nickel. It's gone down like 67%. That's 2/3 down. That's a huge decline. So we know that, okay, nickel futures are reflecting their report sentiment and all that. And we see the nickel juniors, they're being given away basically. So what can we, what can we say about it? We know what the consensus is, because we can see that in the price of nickel, that it's gone down 67%. We can see that in the juniors, that they're priced kind of like they don't have anything valuable and won't have anything valuable for quite some time. Meaning that in whatever jurisdiction they're in, like Canada, US, that won't amount to anything in the next, I don't know, let's say 4 or 5 years or whatever. But the thing is, obviously, that's not important. We're after a risk reward here. The question is, what if the market is wrong? We saw what happens when the market is wrong. Here it was wrong because it was not pricing in the fact that Bear Creek was actually going to trade at $12 instead of 57 cents just 2 years later. It was extremely wrong. You shouldn't get a 2,000% return just like that in 2 years. It's like a black swan event almost. But the thing is, this sector has black swan events so much that you can't even call it a black swan or black swan events. I would say it's predictable human behavior. The cyclicality of it. So my point is, it's like Magna, for example, Magna Mining. I think that's absolutely dirt cheap. Again, it's trading like there's an abundant amount of nickel projects in tier 1 jurisdictions just waiting to go. What if there's a hiccup in the Indonesian supply? What if there's some more export bans? What if some production shut down? What if some companies refuse to, or the Western world refuses to buy dirty nickel? Whatever. There's a bunch of stuff that's not related to, company specific, but it's like geopolitical stuff. And all of that would be kinda to the benefit of nickel, almost. There's probably scenarios that is negative for nickel, but you get my point. It's like there's so much negativity priced in, and we know the stuff can happen because the West is scrambling to secure nickel. Why are they scrambling? Because they think there's a chance that they might get cut off, or they need the companies to have clean nickel, whatever. There isn't that much clean nickel in the West. So what happens if there's, again, a hiccup? There's like a import ban or an export ban from Indonesia, or China says no nickel for you, West. What's going to happen with nickel, Western nickel prices? What's going to happen to the value of the assets in Western jurisdictions? They're already trading for shit, so that we know already. We want to know, see both sides of the coin. We see where we are. It's like a bull and bear market. Here, anybody can see that it's been shit. The question is, where do we go from here? Here it priced in that the mining sector was going to go away. The civilization was going to end. It didn't end. Here it priced in that the mining sector was gonna go away. It didn't go away, and now we're pricing in that the mining sector is going away. It's not gonna go away. That's an easy bet to make. Here it is more company specific, obviously, commodity specific. But it's like, hey, what could happen? I mean, just imagine. It's like, okay, maybe we go down a bit more. Some mines shut down, or there's an export ban, or whatever. EV demand shoots up, or yada yada yada. It's like, okay, we start to have some, or who knows? Maybe the bottom is in here. Maybe we bounce, made a false breakdown here, and it goes up. I'm not saying that's gonna happen. I'm just saying, what if? Because there are no certainties. This was kind of a false breakdown. What happened? Okay, you could draw a trend line from here to here. I guess it didn't really touch here, but it's like, yeah, this looks like kind of a breakdown. A fat red candle broke through resistance. Panic sets in because it looks like it's a breakdown. Then nickel went on a 334% ramp. Imagine you bought a nickel junior, selling at fire sale prices here, and fast forward to here, 2022. Yeah, it's like 2 years later. That's probably, those nickel juniors are probably up hundreds of percent in 2 years. The broader market averages 8 to 9%. So it's like, what's the downside? Okay, we know a lot of them, and that's for gold juniors and all that as well. They're selling for fire sale price. So how much worse can it get? How much better can it get? Well, it's getting immense. It's like down here, how much better can it get? Well, a lot. How much worse can it get? Yeah, it could go from 90 cents to 15, but it's like the upside potential goes exponential the cheaper this sector goes, and the downside just decreases. Yeah, I'm already up to 1 hour 11 minutes. I hope I made some good points, or understandable points at least. That, I don't know, I was going to say the takeaway might be, there's so many things I covered, but yeah, I think just think about this, and then just look at how cyclical sectors work, and just think through it. And it's like, you literally know, you can see on Twitter, this is actually how people act, 95% plus. Everybody's searching for that bull market. And the ones who are still here, and it's like, well, he's not waiting for a bull market. Yeah, they might not be. But how many people are actively buying in that case? And how many have I have, 5% invested or something. I'm not selling. It's like, and I've covered this a lot before. Compare the future returns of 3 people being down here. 1 sells, 1 holds, 1 buys. When we go from here to here. 3 points here. 3 people start off here, go down here, 1 sells, so he's out of the game, he's minus 70%. Other person holds, so he's still down 70% and will be even here. And the third party buys, and let's say he's able to double his investment and jack up his, jack down his average from here, as the holder had, to here as a buyer. He's all of a sudden he's up. Do that in 3 consecutive cycles. This guy who actually bought down here, he made money every single time. Let's say, especially, and of course, the more he buys, the lower his average is, the more he makes. So there's degrees in hell, if you know what I mean. But most people think they're kind of the same. Oh, I'm holding here. I didn't sell down here. I'm buying as much as I can and have I did that from the start, but I don't have much liquid money, I can tell you that right now. And just to try to cover, I guess, last thing about I get asked this all the time when to. I should probably do that in another video. One last point here. It's like I think I showed this short not long ago. Okay, it's like, okay, maybe it's maybe a head and shoulders reversal pattern. Well, now it's breaking down. So I mean, yeah, sure, this could be, I don't know. I was gonna say a double bottom. Or I mean, there's some basher in the chat talking about gap fill. I mean, is that impossible? Absolutely not. I mean, we're not far off, obviously. It's like 5 cents down or something, and then you have a gap fill. But it's like, does that really matter? Given that I think Magna was already way too cheap and has been way too cheap almost throughout its entire existence, basically throughout its entire existence, since this doesn't appear to have been a turn, that it was a reverse head and shoulder, is that a good or a bad thing? I own Magna. Is that a good or a bad thing? It broke down. It didn't start a bull leg. It went lower. We're down to this level. Again, is that a good or a bad thing? 95% will say that's a negative. Why? Because you're down more on paper. But again, it's not where we are. It's where our long-term results, and especially if you use dry powder or whatever, it's not where we are or have been. It's where we're going, etc. So when you just think about it, let's say this was the bottom. Let's say this is the bottom. Let's say it gap fills 5 cents lower or something. If you just held, doesn't really matter. You just take more paper losses for a while. More if it goes here, less if it turns around here. Still, you will still get the 186% in that case. It's just a way of getting there. So in this scenario, this is the position you had here is on a 186% future return in, let's say, 5 months, whatever. I'm just trying to make a example here, of course. But this wasn't low. It went down here. Again, assuming we're gonna go up here, you're still gonna get the same returns. It's just that it took a slightly different route until you saw that green. But now you also have the option to buy more. If you use that option in that case, lowering your average to, slightly to down here. 207% instead of, let's say, 182. That's still a more than 10% addition from just, what is that? One week, excuse me, 1 week or so volatility. Something that's too cheap already got a bit cheaper. So in that case, it would actually be depending on how if we acted on it, it's actually a good thing. If it goes even lower, that would be an even better thing. Assuming our base case of the future plays out. So, which goes back to my original point. A bear market or a correction is not negative by definition. It depends on what you do. And the amount of due diligence and all that, of course. One person could have bought here, sold here. One person could have bought here, bought more here. One person could have bought here, bought more here, but sold here. There's a ton of endless amount of scenarios. And every single time we do something that makes sense, it's not that there's a guarantee we're going to make money. But as long as we have the, in my opinion, value mentality, Uh, Now and then, hope preferably a lot of the time, especially when we go for the risked asset, whatever, we're gonna be more right than wrong. So if we get the opportunity to buy lower, that means our wins return more. We need lower hit rate. If we have the same hit rate and just buy cheaper, we get even more than the person who had the same hit rate but didn't average down and all that, and especially more than the person who sold or whatever. So think about that, because like with Magna, for example, uh, uh, again, is this decline a good or bad thing? For your bragging rights, for your portfolio, whatever, from this point to here, it's not been good. From this point to here, it was good. But the question is not where we've been. The question is what's going to happen. Well, I shouldn't say what's going to happen. I should say our expectations of the future and how that boils down to a risk-reward function and how we use that. I mean, that's the thing. It's like investing is an art, not a science. So I don't have any strict rules for anything. But actually, I'm just going to cover a short thing about selling. It's like, yeah, people ask me, when to sell, whatever. I mean, if we're talking a truly, totally, I was going to say, robotic value investing approach, it means that, let's say the news here, for example, when they acquired Greenhill. So let's say the value was here before the news. Or let's say here for Shakespeare before the news. Greenhill gets added, it's here. Well, I think actually it's much higher than that. Let's say Shakespeare was here and Greenhill is like up there. Okay? Obviously, from a pure risk-reward value basis, the maximum position size you should have is when the price to value gap is absolutely the highest. So if you think at this point in time, and I'm just going to assume that there was no news happening after this. Let's say this was pure on, there's been no news, no change in value even, no swings in the nickel price. We're talking just from a theoretical perspective of price value. After the news, this was the lowest point. So this, in theory, should be the point where you have the highest portfolio size. Let's say you have 10% here of your portfolio in Magna. If price goes up and price to value goes down, the position size goes up, obviously. I mean, let's say it's up 20%. All of a sudden you have 12% in Magna, assuming no other company did any changes in price. But if we're strict, again, robotic, like perfect value orientated, if there was no news, no value change, just price change, portfolio position went up to, let's say, 12% from 10. Whereas in reality, since it's a bit less cheap, maybe instead of having 10 here, when it got a bit less cheap, maybe we should have 9% or 8%. Instead of what typically happens is, it goes up, position size is larger, then we might get FOMO because now we actually believe, because the market is telling us that, yeah, this is actually too cheap, and other people agree with that, that's why it's going up. And you add, the one thing to note here, in my opinion, is that forget about perfection. I get FOMO in my own stories. I get affected by price swings. Ah, it's my back that's hurting. That's why I'm making some noises. But the short answer is I'm very bad at selling. I'm good at buying, not at selling. So imagine you have let's say you have 10 different Magna minings. You think all are cheap, you bought in here, you think they're valued here. Let's say 3 of them went up here. The other ones stayed here or some went lower. Then I would probably, hopefully execute some value shuffling. Sell some of the ones that they might be cheap, but they're not as cheap as the ones that are still here, and certainly not as cheap as the ones that actually went down in price, even though value is still up here. So you sell some of those to get into the other ones that are cheaper, and maybe this one that you sold, that goes down like here, and maybe some of the ones you thought were very cheap, they go up here. Then you can do the opposite. Then I take some of these that are still cheap, but not as cheap as this one right now, which started not too long ago, was actually not that cheap anymore. I mean, it's like a whack-a-mole thing. So it's the buys themselves, the relative opportunities that take care of the... I mean, who knows? Maybe you were away for a few days, all of a sudden you see a stock up here, and you know another story that you think is this cheap. And you're like, okay, I have no idea if this is a top or anything like that, but I get more for my money down here. Here I'm paying, I don't know, $1 per pound of nickel or whatever, instead of $3 per pound. I mean, I'm just making up I'm just throwing numbers out there, but that's the thing. That's how I work. I'm very bad at trading. I'm very bad at selling. I'm bad at market timing and all that. The only thing really I think I'm pretty good at is having the value mentality. Being able to buy when stuff gets cheaper, typically. And in that case, since I'm typically fully invested, that means I need to sell something to buy something else. So even though I don't know if a store is a sell or whatever, or not trying to even, that's why I typically don't talk about selling, especially that. Or I don't talk too much about buying or selling lately. I mean, I don't want to, because, well, it's hard because people are like, what have you bought? It's like, okay, well, I bought X, but it's not even, my top 10 conviction pick. It's simply that I didn't own any, or I have too much in the top 10 already. So it's kind of, it doesn't say that much. It's the same with selling. It's like, oh, what have you sold recently? Let's say I have a 30% in Magna, and 30% is way too much, and I sell down to 20%, and it's still, my largest position up here. If you say, well, I sold Magna, how are people gonna see that? I mean, people assume that means you sold. You don't think it's worth much, or it's overvalued. It's like, well, it could be that it's like it's way too big of a position, and I still think it's the cheapest one. Let's say. That's why it's just the action themselves, especially for me who is all in all the time. I mean, I simply reshuffle. I tend to not too often just sell an entire position or anything, but I adjust. Thanks to volatility, that's the thing. So I mean, volatility, that's what I call the poor man's dry powder. If you have a bunch of different stocks that just go up and down, or it's like, okay, this point in time you have 3 stocks you have value up here, you have stocks trading like this. Okay, I'll sell some of that, pile into this one, maybe a bit into that one. I'm just gonna do this actually. So we have some different coloring. Okay, sell some of the purple stock because it's not that cheap. I buy into that one, and a bit into that one maybe. Fast forward to whenever all of a sudden the prices have changed. The cheapness have changed, so now purple is down here, and all of a sudden the one I bought most of, that's up here. Okay, I sell some of that. It goes into the purple one perhaps. Okay, that purple one goes down and this one goes down as well, but now the third one goes up a bit in price, and again we have the value function here. All of a sudden I'm selling this and maybe even this one to buy that one, and sooner or later this one goes up and they are something like this, and this position has become quite big, so I spread some into these ones to keep the positions kind of even, because all of a sudden they're almost equally cheap. And I add that diversification. Then like a month later, for some reason somebody needed money and this all of a sudden got sold off, then I sell some of that to get into that. So in that case, like you can make stuff happen. I mean, you can create future returns from volatility alone, even in kind of a sideways market. And that's the stuff I mean, when we really go into a bull, I mean, everything will go everything will literally go up. But in the meantime, it's like volatility is the poor man's currency. Yeah, thanks for listening. This sure went long. Hope you have a good weekend. Consider me biased. Assume I own shares of all companies I mentioned. I don't own shares of Bear Creek Mining. Magna Mining is a sponsor, so I'm biased. Yeah, thanks for listening. Bye.